capital loss does not behave on a straight line. It operates on a geometric curve, making every incremental drop exponentially harder to escape. If a portfolio drops by 50%, recovering that capital does not require a 50% gain. It requires a 100% gain just to get back to zero. This chart tracks a baseline $100,000 portfolio. Watch as an unmanaged loss drags the balance down to $50,000. To climb back, the remaining capital must pitch 100% upward just to touch the starting line. This mathematical trap is the geometric destruction of capital. Catastrophic failure in financial markets is rarely caused by a lack of predictive skill. It happens almost exclusively because traders allow large, unconstrained losses to enter their system, crossing a mathematical threshold where recovery becomes impossible. Most retail traders obsess over a single, flawed metric, the predictive win rate. Optimizing for how often you are right is a dangerous illusion if you ignore the underlying physics of capital decay. You can boast a 90% win rate, but if the remaining 10% of your trades are mathematically unconstrained, those few losses will wipe out the entire account. Long-term market survivability requires stripping away all human emotion entirely and replacing it with a rigid, mechanical architecture. A true systemic edge is built upon three pillars: isolating outcut matrices, algorithmic position sizing, and probabilistically mapping consecutive failures. Despite the infinite variables active in the market at any given second, every single executed trade strictly resolves into one of four specific outcomes. This grid plots those outcomes based on two parameters: direction, profit and loss, and magnitude, small versus big. First, we have the two high-frequency, low-magnitude events, the small profit and the small loss. Over a sufficiently large sample size of trades, these two specific quadrants mathematically cancel each other out, resulting in a net neutral impact on your portfolio. A system's entire positive expectancy and the long-term growth of the account is derived exclusively from capturing the third outcome, the big profit. That leaves the final fatal quadrant, the big loss. This is the outcome that carries the geometric decay curve we just established. The singular, overarching objective of any professional risk management architecture is not to force big wins, but to mathematically eradicate this fourth quadrant from existence. How exactly does a trader systematically guarantee that a big loss never occurs? You eliminate it by replacing discretionary risk and heuristic sizing with a strict mathematical algorithm. This is the position sizing equation that dictates exact market exposure. Quantity equals risk in dollars divided by risk in points. The numerator represents your maximum absolute monetary risk allocated to a single trade. To prevent geometric decay, this number must be capped at a maximum of 2% of total available capital. On a $100,000 account, a strict 2% ceiling means your absolute maximum risk per trade is $2,000. The denominator represents the absolute point distance on a chart from your entry to your technical invalidation level, or stop loss. This invalidation distance must be defined by objective chart logic before any capital is deployed. If your technical stop loss rests 10 points away from your entry, the denominator becomes 10. $2,000 divided by 10 points yields your precise market exposure, 200 units. Traders often hesitate right here, fearing that buying a massive quantity of shares or contracts is inherently reckless. The massive position isn't objectively large if the stop-loss distance is tight enough to keep the absolute risk precisely at that 2% cap. True risk is defined entirely by this mathematical quotient. It completely severs your market exposure from subjective confidence, relying only on hard parameters. Even with flawless algorithmic position sizing, professional systems are still subject to the binomial reality of consecutive failures. This timeline plots a long-term sample size of 100 individual executed trades. Notice the unavoidable clustering of negative outcomes. These are run lengths, or losing streaks. Predicting the exact sequence of returns is impossible, but calculating the expected run length of losses is predictable. A 70% win rate mathematically guarantees losing streaks of 4 to 6 consecutive trades. How a trader manages that streak determines if they survive. Risking 10% during a 5-loss streak causes a severe 50% drawdown, but risking 2% limits that exact same streak to a manageable 10% drawdown. Ignorance of this probabilistic certainty is what causes traders to panic, abandoning fundamentally profitable systems right at the bottom of a normal variance cycle. Losing streaks are never system failures. They are mathematical inevitabilities baked directly into the probability distribution of your win rate. This brings us to the ultimate fundamental distinction between recreational gambling and the strict architecture of professional quantitative trading. Gambling is the acceptance of unquantified binary risk without any structural edge. Trading is a probabilistic business governed by strict parameters and risk quantization. A high predictive win rate is utterly useless if a single sequence of variance is allowed to bypass your risk controls and trigger geometric capital decay. The actionable architecture is clear. Enforce a rigid 2% risk ceiling. Calculate volume exclusively through the position sizing algorithm, and anchor your psychology to the mathematical certainty of losing streaks. When you mathematically cap the magnitude of downside variance, probability is forced to do the heavy lifting for long-term growth.